officer training series with the mortgage calculator. Today, we're going to be going through a presentation on interest rates and the economy. So, some top level stuff going to be very interesting. Our sales manager, Jose, 28 years of experience as a loan officer and a major in finance as well at the University of Miami, right? So, he's going to give us some good info about interest rates and the economy and how those correlate. So, going to be a great presentation here for today. We'll wait just a minute here to get started. That way we can give everybody a chance to jump on and go live on all the different platforms. Thank you, everybody, for tuning in on all the different platforms: YouTube, Facebook, LinkedIn, Spotify, Apple Music. We appreciate everybody. And feel free to drop some comments there in the chat. We put the chat up on the screen. So while we wait to go live here, feel free to drop a comment. You can also drop comments as well as we go through the presentation in the chat too. If you got some questions for Mr. Jose. And with that being said, it looks like we are live on all the different platforms, so we can get started. Keep dropping comments in the chat and drop any questions you have as well as we get into it here. So, welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that does loan officer trainings on different topics every Tuesday and Wednesday at 7 p.m. Eastern Time. Now, today's training topic is going to be interest rates in the economy and how those correlate with each other. As I said here a little bit earlier, we are blessed to have our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor and a finance major from the University of Miami. So he has a lot of info to give us here. Let's go ahead and hand it over to you then, Jose, and let's talk about it.
Good afternoon or good evening, everybody, as we have loan officers all over the U.S. I'm sure some of you are in California. Now, at the Mortgage Calculator, we pride ourselves in the fact that we are loan consultants. We train our MLOs to be loan consultants, definitely not application takers. Tonight's topic is one that I think is very important uh, that you understand it in order to be an effective loan consultant, because there's nothing better than to be able to give some good advice to your customer regarding current trends, recommendations when to lock, things like that, just to give them to empower them so that they can make a good decision, right? That's the key between an application taker and a loan consultant. That's the key to adding value to the transaction, staying relevant, and basically getting the deal, getting the borrower to work with you over the multitude of people that are probably sending them quotes, right? Just quotes. But you're not just sending quotes, right? You're offering a full service for the same cost, right? Loan consultant is very important. And in today's environment, highly competitive for properties, limited inventory. Uh, Investors, once they get the deal, and borrowers, buyers, once they get the deal, they don't want to lose the deal. So they really want that top level loan consultant handling their transaction. And that's critical that you understand that, because that's one of the important components of having a successful and sustainable career in this industry, right? It's not just about the rate, it's the total package, right? Our rates are great, our service is amazing, and our products are almost limitless. So, a lot of good reasons um, to choose a mortgage calculator. So, let's get right into it. I love this topic. With our team, we always share different, when we love sharing like the 10-year treasury. Obviously, right now, it's not something that you're gonna want to see in the mornings. When today's not a good day to lock. Normally, we're the other way around. We're seeing the 10-year tracking. I'm looking at it at 7 in the morning. I'm sending out that chat group message. Today's a good day to lock. Look what the 10-year treasury is doing. and and obviously in this environment of volatility, even more important. I mean, I just personally had a loan close, $1.6 million loan, and I locked that in at 201 on the day that the Fed had their open market committee. When I saw the comments that they were saying, they didn't say we're raising the rates. They said we're holding the rates steady, but we're gonna keep an eye out because we don't think that we're done raising rates. Oh my God! I heard that. I ran as fast as I could, and I requested the lock. Let my lock desk know I requested the lock so they could jump on it because I knew I had minutes, only minutes to spare to lock in that rate. And on that size of a loan, it makes all the difference because in the course of that day, pricing changed. And had I not been aware of what was going on due to a little bit of the awareness that I have of what we're going to go over now, I may have been totally oblivious about what I should have done at that moment, which is I did the right course of action. But had I been totally oblivious to that, it would have been not a positive situation when the cost on that loan could have gone up by half or three quarters of a point. I think is pretty much what it went up the next day. The same rate was like costing almost double. So that would not have been a good conversation to have with the borrower. Probably would have cost me earnings because at that point I may have had to make a concession. Who knows? But at that point, uh, it was averted. Disaster was averted because I just followed some basic steps, and I'm going to just enlighten you a little bit tonight so that you can hopefully do the same. So here, real basic, right? It's like finance 101, right? What is interest? Well, that's the price you pay to borrow money, and it's typically expressed as a percentage rate, usually as an annual percentage rate. Now, there's different forms that interest can be calculated. We're not going to get into all of that now because you're talking about simple interest, or you're talking about interest that's compounded, like we have with our amortization tables and stuff. So, a lot of different ways that is calculated, but just be aware that it is the cost basically of borrowing money. Now, interest has a purpose, right? It is basically a motivational factor, right? You have savers and you have borrowers. The savers are the ones that are basically providing the supply of money to lend because they want to make the interest. The borrowers need that money so they could consume something for which they have not been able to save. So they need to pay for that benefit to have the money now that they didn't save, right? That's the cost to borrow money, interest. Now, to put this into perspective, right, since 1971, right, over the last 52 years, our average interest rate is 7.74%, right? Pretty close to where we're at right now, ironically. Uh, but you're looking at a low of 2.65% in the heyday, January 2021, and a high of 18.63% in October of 1981. Now, some of you may not have been around then. I was. And that was an era of stagflation, right? What is stagflation? That's when you have a stagnant economy that is suffering from inflation due to an overheated economy, due to an increase in money supply. A lot of different reasons why it could be happening. In this case, they had they were basically trying to control the economy by raising the rates, and they ended up, putting making the economy stagnant. Not a good period, as you can see, 18.63%. Now let's talk about some of these macroeconomic factors that could have an effect on our rates now. What inflation is one that everybody's hearing right now, right? The Fed is trying to fight inflation, right? Now that's very serious because the only way the Fed can counter inflation is basically by slowing. They figure by slowing down the economy, right? You have an overheated economy due to a lot of different reasons. Like right now, we have too much money going to into the economy. Money supply increase. That money gets picks up velocity, and you get where we're at right now because basically the only way the Fed then can counter inflation is by raising the Fed funds rates, which increases all other borrowing costs down the line. So inflation is one factor that the Fed analyzes. Unemployment rate is another factor, or employment rate, depending which way you want to look at it. They also have another one, I can't remember, I think is like the actual employment utilization rates, the actual percentage of people that are actually looking and employed. That's like 61% right now, 62%. But the logic on unemployment is the lower the unemployment rate, the hotter the economy. You're going to have more spending, right? And it's going to result in higher prices at some point, right? Supply, demand, demand keeps going up, supply remains constant. At some point, supply may diminish a little, and then the result is higher prices. That's an inverse relationship. So definitely unemployment, and right now the unemployment is I think in the somewhere in the mid threes, around there. I think it was 3.7, 3.8%. So still consumption going on, right? Putting more pressure on inflation, causing the Fed to have to take more action. Another factor, and we're going to expand on these a little bit individually. This is just talking about the factors, but another factor is the gross domestic product, or the GDP of the country, of the economy. That is our production. And, there's it's part of it is services and part of it is manufacturing, right? But our production, our economic activity and production is going to determine our country's ability to pay its debts. Or, are we able to sustain our budget, or do we have to borrow more? And then are we going to be able to pay? Then do we need to borrow more to be able to pay more and then borrow more? It's sort of like a vicious circle, right? So if we borrow more, the rate of the instrument will need to increase, because when we borrow more as a country, that's done through treasury securities, and I'll get into those also in this presentation. But the Fed issues more treasury securities to get more money, and then if that increases the supply of those securities, then they have to increase the yield on those securities to make it up for the investors who are going to be buying it at a discount, because they are in higher supply and they got to sell them. It's sort of like a catch 22, right? If they want to issue more securities and increase the supply, chances are they're going to have to increase the yield to make it more attractive for the investors to buy. Hence, the rate goes up. So you can see how gross domestic product, or for example, a decrease in gross domestic product, could result in higher rates because we have to borrow more. When you borrow more, you have to raise the rates on the instruments that you're using to borrow. So, who is the culprit for all of this action? Who these bad guys, right? The Federal Reserve, right? Federal Reserve sets interest rates directly or indirectly, as you'll see, manages the money supply, regulates financial markets, and acts as a lender of last resort during periods of economic crisis, as some of you would have seen during the pandemic when they were doling out money to banks and stuff like that. Now, the Federal Reserve is not actually like a federal bank, and it's also not a totally private organization. It actually consists of a federal agency, uh, and 12 privately chartered regional banks like the Federal Reserve of Chicago, Federal Reserve of Atlanta, Federal Reserve of Boston. All of those are privately chartered regional banks. Each has a head, and those are the individuals that meet in those Federal Reserve open market committees to decide if they're going to raise the Fed funds rate, so forth, and so on. The Fed controls, we talked about treasury securities. The Fed controls money supply through open market operations, which is the selling and purchasing of treasury bills and government securities in order to regulate the money supply in the economy. Right? They did a lot of that during the pandemic. Um, Fed funds rate, right? Now that is the direct interest rate that they control. Right? The Fed funds rate is a short-term rate. It is the interest rate at which banks and other depository institutions borrow and lend excess reserves to each other, usually on an overnight basis, to meet their reserve requirement. Now, reserve requirement is another way that the Fed controls money supply and interest rates and all that. Because if they increase the capital minimum reserve requirement that a bank needs to have, that's a certain percentage of all the loans that they have outstanding, you have banks that have excess reserves, and then you have banks that aren't meeting that minimum capital reserve requirement. That's what they're talking about when they mean excess reserves. Not about overall reserves, just the reserve the reserve requirement that you need to have. Then those banks lend that money to other banks overnight via the Fed, and that's called the Fed funds rate. The banks that are borrowing money to meet their capital reserve requirement, or else they would be liquidated and put out of business. So you can see how increasing Fed funds is going to increase your cost of operations. Increasing the reserve requirement is also going to increase your cost of operation. You can see how this is going to affect short-term rates on consumer loans, credit cards. It's going to affect the prime rate, and it's also going to affect mortgage rates. Right, prime rate. That's the rate that banks charge their best customers. So you could see how Fed the Fed flexes its muscles um, to affect our our interest rates and our mortgage rates. So when they're selling, for example, if the Federal Reserve needs more money, what they were doing during the pandemic, they were monetizing the bonds. They were issuing the treasury securities, and then they were turning around and buying it themselves. Pretty weird, right? But that's what they were doing to increase money supply, and unfortunately, that's the reason why we have the high rates right now. There's a lot of money in the money supply. It's just out of control, and it's a shame that they have to ruin the economy to lower the rates, because that's basically what they do. They slow the economy down. So, as we're getting into it here, increase in Fed funds rate by the Federal Reserve makes it more expensive for banks to borrow, and the banks pass on the higher costs to consumers by raising interest rates on consumer loans and mortgage loans. And also to note, capital flows in and out of markets, like the stock market, also affect short term rates. And the reason is because most people park their money in a money market fund, right? So they sell stocks, they're going to put it in a money market fund until they decide what they're going to buy with it. They're going to buy stocks, they're going to pull out of the money market, and the same with securities. Sell securities, goes into money market, buy securities, but the money market funds back the fund with treasury securities. That's how they generate the interest, because they need a really liquid instrument to make interest on that. At the press of a button, essentially they can liquidate that security when a depositor goes in and says, give me my $250,000, transfer it to Schwab because I want to buy that stock right now, or whatever they're going to do. Okay, they do that, and immediately the order goes in to liquidate $250,000 in treasury securities to fund that withdrawal of money. So you could see how capital flows in and out of the different markets, like stocks and bonds and treasury securities, could actually affect the rate because now you're affecting the supply of the treasury securities. When people are liquidating to buy stocks, so you can see when the stock market has a crazy day, you'll note that usually on that day, unless it's having a crazy day because there's some other uh, economic news that's going to affect rates. But usually, when stocks are going higher, like one of those real crazy days, you'll see the 10-year Treasury is also going to be going higher because people are cashing in money market to buy stocks, and that's resulting in Treasury securities being sold, or actually, yes, given back, and it affects the supply. And then you got to raise the rate. Extra supply, they got to increase the yield to so that they can sell those securities. So, oh, sorry, here you go. Hey, sorry about that. Had another problem with my mouse. So here's where we're basically just finishing tying it all in. Uh, these U.S. Treasury securities, like I mentioned, are debt obligations, right? They're issued by the U.S. government, secured by full faith and credit of the U.S. They help fund the government. So we mentioned how when they're monetizing these securities, how it's going to affect the rates, right? You're issuing them, you're buying them back. At some point, rates are going up. At the other point, rates are going down. So and right now, the one that we should probably follow the most, the one that we like to send in those chat, is the 10-year Treasury. The 10-year Treasury is the one that most loans will track. So if you see the 10-year Treasury starting to track up, or you read about it's going to track up, that's a good time to have a conversation with your borrower if your loan is not locked in already, to suggest locking it in. Right. So many factors that can affect rates, like what you can see, but it's pretty basic. If you're looking at money supply, if you're looking at U.S. Treasuries, unemployment, inflation, all of these factors that we just mentioned right now, directly or indirectly, will affect interest rates, which then will directly affect the mortgage rates because usually it's just a spread. They get the money, it costs them a certain amount, they add their margin to it, and the consumer pays the mortgage rate, based on the margin and the raw price. So I hope that this enlightens you all to know a little bit about the mechanics that are a part of interest rates, what you can do, what you should be aware of, and probably in one of the next sessions we're going to have one on rate lock management. That's going to be another one that's very important and related to this topic.
So what does this all mean, Jose? What do they need to watch? Right? You said watch the Treasury, but don't watch the Treasury, and then you had all these interrelated things. What are some of the things that they can actually take out of this to keep an eye on?
Well,
The 10-year is
the
definitely
10-year,
something.
yeah, 10-year.
Anything else that for them to keep an eyeball on?
Well, inflation, obviously, if inflation is tracking down, if inflation is tracking up, the unemployment rate, if the unemployment rate is tracking up, or if it's tracking down. If it's tracking up, that means the spending in the economy is going to slow down at some point, which means at some point inflationary pressures will ease as well, right? But I mean, I would say a lot of this is just background education so that they can know what they're actually looking at when they're looking at the 10-year Treasury tracking up and down, and they can analyze the factors that they think is going to affect the 10-year Treasury, because that's probably the biggest benchmark that we can look at here. And
Hey,
there's another factor that's going to affect interest rates also. Um, Above and beyond this is going to be secondary, the flow of money in and out of secondary markets. We touch base on this in a lot of our trainings and podcasts that we do, because right now, with this, with what's going on, all the volatility, there tends to be more volatility in the agency market for mortgage rates than there is in the non-QM market, uh, because there's more money going right now into the secondary market for non-QM, right? So we're seeing the rates in the non-QM market maintain a little bit more stability, because they don't necessarily track the 10-year as closely for their rates as agency does. Agency doesn't really worry so much. I mean, they not going to say that they don't worry about lack of liquidity, but agency has the agencies, Fannie Mae, Freddie Mac, Ginnie Mae, which is basically that's a guaranteed purchase, versus non-QM, which is Wall Street based, and definitely has to do a lot more with liquidity. So there's very good liquidity right now in non-QM, which is keeping the rates lower, uh, I guess, comparatively compared to what's going on with agency.
Right. So you're saying more people want to invest in non QM products from Wall Street, basically, which is making it so there's more offerings to the customers, lower rates, more competition.
Absolutely. In a nutshell, that's exactly what's going on. So more money there. They're competing for our business, and they do that by making their pricing more attractive and also by easing guidelines. So we're seeing a lot of that in the DSCR and in the ITIN loans.
All right. Surprisingly, I don't see any questions here. Thought we'd get some questions. But yeah, great overview there. I love it. It was perfect, I think. And just keep your eye on that. And I guess the big takeaway, as always, here would be the 10 years going to track closest for our business, right?
Yes, 10 years, the one to look at, the one to follow. But again, all of these factors come into play, but it really culminates in the mortgage industry with the 10-year, uh, because that's going to be affected by what the Fed does. So all of these other factors that we spoke about will affect what the Fed does with the treasuries, and the treasury that affects mortgage rates the most is the 10-year treasury.
So basically, anybody, obviously, we should be keeping an eye on this, but anybody who's going to lock a loan anytime soon, that's in the middle of a loan, you're saying you better wake up every day and check that 10-year that day and see, what the status is.
Yeah, I mean, I like to look at the Asian markets before I go to sleep at night. They're already tracking information. So they're 12, 14 hours ahead of us, and what's going to happen in the morning a lot of times when you're looking at that. So yeah, there's a lot of different things, but for sure, you can't have your head in the sand. You just can't have your head in the sand and think that nothing is happening and every day is the same, and you're just gonna go today and you're gonna go to your pricing and it's gonna be the same as it was yesterday, because you'll be in for a really big surprise. I mean, success can hinge sometimes of your loan can hinge on locking a loan when it should be locked, or and disaster could be missing an opportunity to lock, and all of a sudden customer doesn't like that new rate, it's a refi, and they may just tell you, I'm sorry, Jose, it's not cost effective, there's no tangible benefit for me anymore to do this loan, right? So um, you know this behooves everybody to know. I'm not saying you got to be a financial management expert, but you got to know a little bit, just enough to pique your borrowers' interest in the topic, so that they can consider it, and you guys could have that discussion and lock the loan when it should be locked. Right? If you like it at the beginning of the application, everything's ready, everything's disclosed, then maybe that should be the moment to lock.
All right. Well, thank you. That was perfect. I don't see any questions. Remember, we do this Tuesdays and Wednesdays at 7 p.m. Eastern. So next week we'll be back with some topics. Thank you, everybody, for tuning in. Thank you, Jose. Great presentation. Thank you, Nick. And we will see you all next Tuesday at 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thanks, everybody.
Good night, everybody.